There's a really interesting area of ag investing that admittedly I didn't know too much about. It's not quite like early stage venture capital and not quite like private equity either. It's called growth equity, and Jim Taylor has been deploying growth capital in food and ag companies for over 20 years.
We like technologies that are kind of cool that we can understand, but we also just like plain old good businesses that need capital to grow, and really they're about superior execution, not so much being the only mousetrap of its kind.
Jim is the founder and managing director of Forage Capital Partners, and today he shares the past, present, and future of where he sees proven companies and business models that need this growth capital and expertise.
I really believe the opportunities that are going to show up are really around how do we deal with some of the environmental constraints around agriculture that are real. I do think there needs to be more attention paid to variable rate, and I think there's a huge opportunity on the production side, both on the equipment and food production and fertilizer production, to bring a lot of that stuff back to North America.
Jim Taylor shares lessons from 2 decades of investing in ag companies on today's Future of Agriculture podcast. Well, hello, fellow ag nerd. Thank you so much for joining me for another episode of the Future of Agriculture. My name is Tim Hamrich, and every week you and I get to hear from the farmers, founders, innovators, investors, the people shaping the future of the ag industry. I'm very pleased that this quarter of the Future of Agriculture podcast is brought to you by our quarterly presenting sponsor, which is SwapMaps. Because when you know more, you grow more. SwapMaps variable rate technology helps you understand the why of field variability and how to better manage it. Understanding soils is the core of a successful fertility program, and SwapMaps allows you to map, measure, and better manage your soils using data that accurately delineates areas with similar fertilizer response characteristics. Turn your data into actionable value with SwapMaps. They're your trusted variable rate provider on millions of acres currently, with a 98% retention rate. SwapMaps, they do variable rate right. Learn more at swapmaps.com. Book a consultation or just check out more information. That's swapmaps.com. But you don't have to take just my word for it. Listen to Tyler Kessler talk about how SwapMaps opened his eyes to the potential of variable rate and how it's worked for him as both a farmer and agronomy consultant working in southern Saskatchewan.
I started being introduced into SwapMaps, and that really was the turning point of where I believed it started to make sense for me. I could see it started making sense for the clients. And it was the base layer of if you're actually dealing with physical properties. You're not dealing with just yield maps. You're not dealing with imagery to try and, market a scalable business. In our case, we've got 99% retention. Anyone that has tried it continues to increase their acres and they want more.
You can hear more from Tyler if you'd like on our most recent Field Report segment, so go check that out if you haven't done so already. And of course, visit swapmaps.com to learn more. All right, now back to our featured conversation today with Jim Taylor of Forage Capital Partners. Jim has been involved with financing growth companies for over 20 years now and has created and managed 7 different funds prior to Forage. He was a founder of 3 growth equity funds, 3 subordinated debt funds, and the Farm Credit Canada Ventures Direct Investment Program. Jim has raised and managed over $500 million of growth capital in the ag and food industry. Jim has definitely carved out a reputation as the go-to person for anyone with an ag or food company that has a proven product or business model and is ready to take on outside investment for growth. His approach that you'll hear all about here in just a minute makes so much sense to me as someone who often finds myself skeptical of a lot of what I see in early stage venture capital. It's a totally different approach. But we've never covered something like this on the show, so I'm really excited to drop you into this conversation with Jim Taylor of Forage Capital Partners.
There are a number of funds focused on the industry now, but there wasn't always. and wasn't always, cool and trendy to be in ag. And way back in 2002, I remember starting up and, going to a growth equity and venture capital and private equity conferences. And, we'd tell people we were launching an ag focused venture fund, and they'd sort of giggle and say, oh, good luck with that. The clean tech guys, when clean tech didn't necessarily go the way everyone hoped it would, they kind of reinvented themselves into ag guys. And so it got a bit crowded for a while. And, that sort of washed through now. And there are some very good, experienced funds in the United States in particular, but there's a handful in Canada too that are pretty good now, 22 years on. And so it's a pretty robust ecosphere, and it's good. There's ways to bring additional capital to deals. There's a little more competition, which is good for the entrepreneur. And there's been a number of successful exits now. Companies have grown up and made money over the last 22 years, and that attracts attention, right? Investors look at that and say, this is a good place to make money. And so it brings investment skill and it brings capital, which is at the long run is good for the industry, right?
Yeah. And how would you explain growth equity to someone maybe not in the investment business relative to more earlier stage venture capital or to private equity?
Yeah. So what we tell ourselves it could mean many things to lots of people. What it means to us is, we like businesses that have been around for a little while, that have developed products or services or technologies that people are paying for. So it's not a beta test. It's not, we need to develop a market for a new product or a new concept. It's, we have customers who are using our product, service, or technology. They're paying for it. And now we need to, grow that distribution or increase usage of the technology or build out partnerships that will drive adoption of the technology for the benefit of the industry and ultimately create value. And so we're not afraid of companies that are losing money as long as the gross margin part of it is healthy. If there's a heavy spend kind of in the admin part of the P&L, SG&A part of the P&L to build a business, we're not shy about funding that and driving, top line growth that'll eventually sort of drive the business to break even and ultimately to profitability. What we don't want to do is, we're not scientists, we're not, PhDs, we don't have, that kind of background. And so, trying to assess, whether a technology or a product or service will work, whether it's effective. We don't want to pay to retrain customers to use what we have. We want to invest in companies that have already done that kind of work. And so that's the growth equity, right? We don't mind burning cash to grow we want to take, I guess the best way is we want to take execution risk, not technology risk. Because we feel like our backgrounds, we're good. We've done lots. We've been, some of us have been operators before. And so we're good with execution, and we'll leave the science to the scientists and the developers and that sort of thing.
Yeah. And tell me about the deal flow within that constraint, both in numbers of deals and types of deals. How has it changed over the last, I guess since 2006, since you've had Forage Capital, but even further back, the last, 22 years or so?
Yeah. So the deal flow's always been relatively strong. Initially, it was a pretty uncrowded space. And so there was, lots of deals. There's always more early stage deals than growth stage deals. Now, I'm not an early stage investor. I guess those folks would say, well, there's a dearth of really good early stage deals, and I believe that's true, but we don't play there. So there's lots of emerging ideas and technologies. What's harder is to find those businesses where, somehow they've been able to muscle it up into existence and to get customers and have something that's valuable there. But deal flow has been good. There's a lot of good businesses. And one of the places where we see it is, there's businesses that have been around for a long time and have gone through some sort of a generational transfer. So, either the management team has bought it or, partners bought out another partner. And the new ownership, wants to take it from, it was a $5 million business for, 10 years, 15 years or longer. And the new owner is younger, more dynamic, less intimidated by taking on capital, and really has a vision to grow the business. So those are good places for us to invest. We've been involved in a few of those, and we like that. And there's lots of those around. You know, in Canada, a lot of those businesses will come out of some of the less traveled places. We've done a number of deals in Winnipeg and Western Canada, parts of Saskatchewan, Alberta. Ontario has been a great place for us. There's lots of good small companies, and more recently there's been a real focus on for small manufacturers back to Canada to shorten up supply chains. Really, kind of COVID brought that on, and then the geopolitics of the world. It's an unstable place out there, and so lots of businesses want to have shorter supply chains. And that's created opportunity for some of these businesses to really grow their production capacity in North America, or to find partners if you're a Canadian company, to find a supply chain maybe in the US instead of all the way across the ocean, or so it's been good. We've enjoyed that, and that's really been a real opportunity for us.
Yeah, so I think that's it's illuminating that in the stage in which you're investing, you're less bound by tech-only investments, right? Whereas maybe an early-stage venture capitalist, if they're betting on idea, it probably needs to be a pretty proprietary idea, maybe an industry-shifting idea. But for you, it doesn't necessarily have to be tech-driven, does it?
No. So we're not. We don't mind investing in established technologies. The limitation that we would put on it, honestly, is when I was younger, some 20, 25 years ago in this business, people would say, well, you don't want to invest because you don't understand my deal and how great it is. And I think, oh man, maybe I don't understand it. And 20 some years on, if I don't understand it, then we're not the right partner, right? You need a partner that understands it. And, we're not shy to say, that piece of ag tech, you're right, we don't really understand how that works, and so we're the wrong partner. We don't define ourselves as technology either, because ag tech has had some good success, but it's had some fantastic wipeouts as well. And part of my observation over time is a lot of people talk, true ag tech, and on some level it always revolves around the aggregation of data or some sort of data analytic tool or something like that. And really the industry is, as far as I can tell, and again, we're not tech experts, but the world hasn't sorted out whether it's farmers or equipment companies or manufacturers. No one's really sorted out how to monetize the usage of that data in agriculture yet. And that's why we just don't go there, because someday somebody's going to figure that out and they'll probably make tons of money. But the risk is very high still there on how you transform data into dollars. Whereas in other industries, they've sorted that out and they're away to the races kind of thing. The other piece for us where we don't worry too much and don't really focus on the hard technology piece is when you start talking science and tech around crop development or seed traits or novel crops and novel proteins, and that there's a lot of regulatory framework that you got to go through before you can introduce a new technology into the human food chain, like new seeds, new varieties, new chemical, brand new input, that sort of thing. That's great. That's the territory of big ag, right? And there have been some folks who've had successful new ventures there and made good money. We don't play there. It's heavy science, it's heavy research. It takes a lot of money, and there's a lot of regulatory. And so our view would be, seed stage, early stage investing in that area probably doesn't monetize value in the lifetime of our fund, even if it was, a full-on sort of early in the fund life investment. So we don't do that. Not because it's bad, it's just we're not that smart, I guess, is what you could say. So we do tech. We have done some great young technology businesses, but after those technologies have been adopted and deployed, we have done high efficiency fertilizers, but really they're known the properties, the backbone of the fertilizer really is known, whether it's a new version on a micronutrient. Micronutrients have been around a long time. Novel ways to get them into the plant. We've done that. New sources of phosphate, we're looking at that. We understand that. We're interested in how do we use less chemical to get more crop and all of that. But we don't want to start playing around with new chemicals and it's just not us, right? Like we're not experts there.
Yeah, and that's one of the reasons I asked you about deal flow, because I asked Corey Wilness to introduce me to you. Their story of starting in '08 and becoming strong, profitable, growing, but still room for a lot more growth, and finally taking investment, I think 2021. I can't think of a whole lot of other companies like that, but you're often not investing in necessarily technology companies.
Yeah, so that's a but again, that's a 12-year overnight success for Corey, right? Like he did a lot of work for a long time to sort through, and even now, that technology is developing quickly, but there's an established customer base, the retention rates are high, it's pretty clear what it's used for. So in terms of, I mentioned earlier, monetizing the value of the technology and monetizing the information that Corey's business generates for the grower has now been well established, right? And so, the other interesting thing there is from an investment model, Corey's business did it the right way. A lot of companies that are similar to Croptomistic have taken the tack of, we'll give away our service and give away our tech to sign people up, and one day we'll charge them. Well, Corey's never done that. Corey's always said, look, there's value in what we're doing. We're not going to give it away ever. We're going to let a small number of people over time adopt the usage, and they're going to use it, and they're going to see the result, and they're going to come back, and we're going to charge customers a fair price and then service the heck out of the account to make them love us. And so when he got to the place where he needed institutional money, he had long proven how to monetize the value of what he was doing. And he just truly needed capital to accelerate the growth. And it's been a good partnership. The business is doubling every year, and Corey's nailed it, right? Him and Derek, have a really good window on what growers want and how they value and how they need to use the technology. And so far, so good.
And what is the competitive landscape for investment, specifically in growth equity in that size in food and ag? I mean, are there several other firms out there like Forage Capital Partners that are focused on the same area? Because I don't know of any, but I'm not in your world either.
So we would say that we're unique and that we're better at some things than other folks, and have carved out a place where we exist pretty happily with not a ton of competition. The reality is there are some good funds out there. They're in Canada, which is where I'm most familiar. There are more funds that focus on food manufacturing, branded food products. So there's lots of those guys, right? Consumer packaged goods, which touches food. So there's lots of those funds around in Toronto and in Canada. And then there's a handful of funds who would define themselves as ag tech investors, and they do sort of that. We really take the tack in the middle and do a couple of unique things, right? We would say, hey, we do some, food manufacturing, CPG stuff, but not only. And, with COVID and post-COVID, that's been a very difficult place. The whole channel for distribution and input costs and the cost of being present in certain places and the retailers in North America has really changed completely. And so that's a tough place to be. So, our business includes everything from equipment manufacturing to inputs, fertilizer production, businesses like Corey's that are, effectively some form of crop management or input management. But where we really try to differentiate ourselves is we come along and say, look, we're not really interested in having a whole bunch of other funds invest with us. We don't try to build a big syndicate. what we really do is go out and say, in Forage particularly, we're going to invest and we're going to attract some kind of a individual entrepreneur who brings an expertise that we can use in the business. We call them sort of our partners, and we want them to write a check and invest in the same instrument with us. So we're looking for people that we've done business with in the past, that we know and trust, and we're familiar with their track records, and they know and trust us. And we invest together to work with a company and to build it up. And the investee has to A, want the money, B, be able to live with a timeline to a good event, and C, want the mentorship that's going to come from one of our trusted co-investors who's an individual, not an institution. And I think that makes us pretty unique, right?
Absolutely. Yeah, no, that's why I find this story just so fascinating. What I'm curious about is the investors in your funds. What's the conversation like with them if they're not used to investing in this stage, as far as risk and expected returns?
Yeah. So in the early days, as I mentioned, I actually worked for Farm Credit for a period of time way back. And so, then sort of 2006, the beginning of the separate fund business, we did have some other LPs in Canada. Most of those LPs were government institutions. We did have some smaller family offices, rich individuals who put money in. From the perspective of Farm Credit, who has been the largest limited partner in all of the funds, they definitely want to make money for sure. But of equal importance for them has been the ability to attract other institutional dollars into the investments. And so, sort of lead in a place where it's hard to be a leader. They have also wanted, good Canadian businesses and technologies to kind of grow up and gain broader distribution. So they've enjoyed that benefit. I've always been an LP in my own funds. And so my interest is a financial one for sure. My effort is to, create wealth for the partners in the fund, myself included. And so believing in the story that we have and that it provides an opportunity to create wealth both for the entrepreneur that we back. And that's been an interesting piece is we forget, but in an industry where there hasn't been a lot of venture capital going back to 2002, and now there's been others and us, and we've invested lots along the way, you start to build a network of successful entrepreneurs who reinvest their winnings into the sector that they're familiar with. And it really begins to proliferate and to grow. And that's probably the thing at Forage we're most proud of is that, there is now a network after, 20 some years of people who've made money and created wealth for themselves and their families and have reinvested that back into the communities where they live and the provinces and places where they believe they want to do good there, but they also want to continue to grow, their capital by investing in something they know and understand. So that's been a great experience for us. Our LPs, again, have largely been government institutions, so Business Development Bank, Farm Credit, EDC. They've been great to deal with over the years. In the current fund, the Forage's first fund here, Farm Credit is the largest investor. I am the next largest investor together. And so we really started this program during COVID in May of 2020 when a lot of investors were kind of running for the hills, in the darkest moments there in the middle of the lockdown. And we had a lot of companies that couldn't get capital because investors just kind of closed the doors. They suffered sort of catastrophic changes to their business as a result of either supply chains getting shut down or sales forces that just simply weren't allowed to leave their offices and couldn't sell their products. And so the opportunity to step into that and invest aggressively from 2020 to 2022, there's a lot of good businesses there and a lot of really good companies that had a lot of success for even a decade before that. And as soon as things got shaky, banks got nervous and customers got nervous. And what they really needed was some capital that would step in and be patient and take the view that the world wasn't ending, that we were going to get through it. It wasn't going to be easy. And so, we did that, and we made, 11 investments. Unfortunately, some didn't survive, and they won't. But the majority of those companies are strong today and getting stronger and stronger very quickly. And it'll probably be one of the most successful funds that I've had.
Oh, that's fantastic. Yeah, and that's one very interesting thing about your approach versus like an early stage venture capital is they might be expecting the majority. They are expecting the majority of their companies not to make it, whereas I wouldn't think in your case you are.
No. We expect most of them to make it. And ultimately, the unique place where we are too is a lot of times, our businesses get big enough and then the successful ones have continued to grow and frankly have a demand for more capital to continue to grow really beyond what Forage can give them. And so our exit is often to a larger, private equity firm that wants to invest, $30 or $40 million in a business. And so, we'll see the exit to a larger private equity firm that, has a plan to, double or triple it beyond where we can take it.
And I'm sure this is part of the secret sauce here, but to the extent you want to divulge, how do you find these opportunities, or do they find you?
Well, a little bit of both. At this point, I've been around a long time, and so some of them find us just because I've been doing this for so long that many ag businesses in Canada would find us. But the way we really find them, honestly, is a little different. Being willing to go to Swift Current, Saskatchewan, being willing to go to Nacum, Saskatchewan, being willing to go to rural Manitoba and look around and meet the people. A lot of funds don't want to do that. A lot of Toronto-based funds just aren't keen on doing that. So that's sort of one way. And then the other way is just to continue to network within the industry is a great way to do that. And again, our approach has been to be present, where these companies operate. For example, in our current fund, Farm Credit is an LP in more than just our fund. They're an LP in several funds. They're a big institution. And our fund is a little unique in the sense that all but, I think, 2 of the deals we've done, the other funds that they are involved with never even heard of them. Our companies didn't even show up on their radar screen. And so it's sort of back to that growth equity thesis. We're not ag tech. We're not consumer packaged goods. We like technologies that are kind of cool that we can understand. But we also just like plain old good businesses that need capital to grow. And, really they're about superior execution, not so much being the only mousetrap of its kind.
That makes perfect sense. Well, you mentioned that, they haven't all been easy successes, right? So what have been some of the harder lessons that you've learned along the way?
Well, sometimes if you're the first guy or girl to do something, it doesn't always work. And so, we did have an investment in an insect farm, which was great. It was one of those things that looked great on paper. We had customers. It turns out the business just didn't scale the way we hoped. It was tough to operate during COVID for sure, but I would say that was a complication, not an excuse that we could use. It made it harder, but it didn't make it impossible. And so, something like that where in spite of, the thing that we would say we kind of have a pretty good handle on protein markets and stuff, we just got it wrong. The animal pet food regulatory framework just wasn't ready for insect feed. It took longer and cost more to get through the regulatory hurdle. And then sort of a recurring theme in that one and others that we've struggled with, it's very difficult to build a plant, like physical plant, for a new process. And we've typically steered away from that, right? So, when you're building a production facility to do something that's novel, it's really hard to know how long and how much it's going to cost to commission it because there's no book, no one's done it before. And so, the biggest lesson that we've learned across a handful of investments is don't embark on a capital expansion, like a building a production facility unless you've got way more money than you need because it costs twice as much and takes twice as long as even the smartest person will tell you. At least that's been our experience. So that was a rough one. The other thing I think that's tough where we've had some headwinds, we often look at a business and think, okay, the Canadian market is so big, and then we need to gain access south of the border in the United States. And just the cost of doing business and the competitiveness in all sectors, in the United States is just orders of magnitude higher. And so it's difficult to cross the border. When we haven't done enough work or understood the competitive dynamics south of the border and have tried to expand too quickly south, those deals have been tough, right? That often, they've survived and we've been able to get out, but really we never achieved what we set out to do. So that can be tough. U.S. expansion without a good partner down there or a really good understanding of what you're up against is often a fool's game for small businesses in Canada.
That's really interesting. Do these companies always have a board of directors in place that once you become an investor, you join that board? Is that typically how it works?
We almost never do. We would construct the board. Sometimes we try to keep that small initially to the founder, us, and an independent. As the business grows, our view on the board, though, maybe, I don't know if it's different than other funds, but we really view it as an opportunity for the company to go out and engage with the best person, frankly, in the world that they can find that knows about what they're doing. We don't see it as a requirement or an ego boosting exercise to be on the board. And frankly, our view why we don't want a lot of institutional partners, one of the hard lessons I've learned over the years of doing this, you get a small company and you get 4 investors on the board, it usually just gets screwed up. They're not all committed at the same level to having an understanding of the business. Really what a board of directors needs to do is guide the business, not guide your fund. And so you get too many on there and they all have their own selfish interest, which really has nothing to do with building the business. My colleagues might disagree and take offense to that, but I've watched it play out too many times. And so, we would take a seat on that board. One of the management team's members would be on that board, or maybe 2 if there's a founder. And the others, we'd want to go out to the outside world and find people connected to places we want to go, find people with skill sets and experience that the company needs, and build it out that way.
That's pretty cool. I appreciate you sharing all this. I'm curious about right now as we sit early in 2024, do you look for opportunities within a thesis or really it sounds like you're just really looking for good companies and kind of how do you keep up to date with changes to the industry that might be happening?
Well, the second question is an easy one. How do we keep up to date? We're engaged pretty deeply with our investment portfolio. And so, we're kind of constantly searching for new information about similar products, similar ideas, similar technologies, even similar companies or new competitors that may be emerging. We do spend time. We spend a lot of time meeting the customers that our companies have. And so, what do they want? What do they need? What problems do they have? What problems are they trying to solve? And so we gather a lot of knowledge that way, which I really like doing. That's the fun part of the job, is as being involved with the businesses and kind of learning what's coming down the pipe. And then your first part of that question, though, what are we doing in 2024? Unlike other funds, the reality of Forage is we're fully invested now. We have 2 sort of businesses that we've had in due diligence for some time. We will likely do at least one of those investments, but we're not actively looking for any more new investments. And I'm not young, I'm getting old. So this probably is the end of the line for Forage, at least under my leadership. So there will not likely be another Forage fund, but there's lots of cool opportunities out there. And there's lots of, young minds and smart people to take advantage of the opportunities, both as investors and entrepreneurs. And And it's an exciting time in ag. I really believe the opportunities that are going to show up are really around, how do we deal with some of the environmental constraints around agriculture that are real? We don't need craziness. We need real, practical advances in whether it's applications or usage or whatever that can find ways to use less chemical on the ground and get a better result. I do think there needs to be more attention paid to variable rate, and I think that's a huge growth opportunity somewhere, somehow. And I think there's a huge opportunity on the production side, both on the equipment and food production and fertilizer production, to bring a lot of that stuff back to North America. There's a reshoring opportunity, I think. And I think that, our manufacturing business that we own that's grown so quickly, one of the largest benefits to us has been, when supply chains went wonky, we went out and the initial play was we went long inventory on some stuff that we knew other people were going to have a hard time getting, and we were the only guys that had it. And from there, we really kind of became sort of the sole source provider to a whole new set of companies that could count on us to deliver, when maybe they were shutting down production lines because the supply chain involved, either an uncertain shipping line or an unstable country or whatever, right? And we see that in food, and we sure see it in equipment. A lot of the big ag equipment guys, they want certainty of supply. They want shorter supply chains, and we're taking advantage of that. And I think there's way more of that to be done. I think that, an astute new fund would look at that and say, hey, how do we take advantage of that?
All right, well, that is going to round out today's episode with Jim Taylor. Thank you so much to Jim for being on the show. If you'd like to learn more about what they're doing over there at Forage Capital Partners, you can do so on their website. It's just foragecapitalpartners.com. And of course, we'll link it in the show notes as well. Another big thank you to Swap Maps for being our quarterly presenting sponsor this quarter, and to Corey Wilness at Swap Maps for introducing me to Jim. And last but certainly never least, thank you for your time and your attention. I do not take it lightly. I'll be back next week with another story of ag innovation.